If you're watching the market every hour of every day, you're doing yourself a disservice. There is more to investing and trading than watching every single tick, and there is certainly more to life than being glued to a screen. I will outline 15 practical steps to a more efficient trading strategy and hopefully a more fulfilling life that I learned from one of the best trading books, Secrets for Profiting in the Bull and Bear Markets by Stan Weinstein. The weekend is the best time to analyze the market because exchanges are closed. There is no price movement and therefore no distractions. You can analyze the market objectively and rationally and make informed decisions. You should always keep an eye on the markets like the S&P 500 or the Nasdaq on a 6 to 12 month time period to assess the overall direction of the market trend. If the markets are generally going up, you are more likely to find bullish long trades. If the markets are generally going sideways or down, you are less likely to find bullish long trades and you may want to consider shorting. Also, you should focus mainly on the weekly charts of markets and individual stocks, as they provide a clearer picture of past movements and potential future movements. Scanning different industry sectors and groups is the next step in your analysis. This will lead you to finding companies in certain industries that are outperforming regardless of the market trend. For example, even though currently we are going through some economic uncertainty, the market is being boosted by technology companies, especially ones with an artificial intelligence focus. Companies like Nvidia, Microsoft and Palantir have increased significantly in price, even though many other companies are trending sideways or down. Create a watch list of the best performing stocks with ideal setups. Stocks in stage 2 tend to be the best performing stocks when going long. I will briefly go through the different stages in the upcoming steps. Investors have a longer time horizon, therefore can afford to buy earlier and sell later. Generally, for investors, it is recommended that they buy the early bases in stage 2 of a stock's movement. For those new to trading, there are normally 4 stages of a stock's movement as seen in this photo. Stage analysis requires its own video, so I won't discuss it in detail here today. Long-term investors should look at investing at the start of an uptrend after a long sideways pattern has ceased, as seen in stage 1 of the photo. Traders have shorter time horizons for their capital allocation, so they need further confirmation of a trend. It is generally advised that traders should start trading a stock after the initial stage of an uptrend, also known as the continuation. This tends to happen after the first part of an uptrend is settled and the next part of the upward trend starts. You should always have a stop loss on any trade, whether it's a mental stop loss or actually setting it with your broker. Generally, it's advised that the stop loss shouldn't be more than 7% away from your buy point. Losing much more than 7% on any trade makes it very difficult to get in profit long term. However, 7% is also sufficient leeway for any unforeseen movements to the downside before the uptrend continues. When a stock is in stage 1 or 2, the indication is that the stock is unlikely to deteriorate in price and plummet. Keep your composure and hold your stock if it's within your stop loss, as more times than not, the stock will likely head upwards. It's not recommended to buy a stock in stage 3 or 4. It's hard to tell how long the sideways range will last in stage 3, so your capital will become trapped. And you certainly don't want to invest during a price freefall in stage 4. It could be years before the stock recovers, if at all. If you notice strong downtrends in the markets and feel strong negative sentiment, going short could be a consideration. It's a lot more dangerous than going long because of the potential loss. However, during a strong downward trend, you can make large profits in a short period of time. Never try to guess the bottom of a stock. It's extremely hard and not worth the effort. It's always best to let a stock trend sideways and shake out all the sellers. This will build a stable stage 1 base, which you can use to analyze and anticipate the next stage 2 part of its price movement. Don't feel the need to be invested at all times. The time to invest is not always now. Staying in cash when unsure or not confident in the current market is the best thing to do. Liquid cash provides great optionality for investments that may appear out of nowhere and that can provide a great return on investment. The perfect trade is buying stage 2 strength and selling stage 4 weakness. If you can take a ride on the upward price movement of stage 2 in the stock and get off the ride when you notice excessive selling and downward price movement, you will have executed the optimal trade. You can never know when the top and bottom is, but if you can catch the middle of the move, you can make good profits. Always follow price action when making trading decisions. You should be keeping a very close eye on volume and price. They are the leading indicators of the direction of a stock. Earnings are important for long-term investors, but for the shorter-term movements of a stock, price and volume are the key tools for the aspiring speculator. Stage analysis applies to all financial instruments, whether that's stocks, commodities, bonds, etc. Make sure you keep an eye on all parts of the markets.